following podcast was recorded on Tuesday, February 25th, 2025, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to Talking Data. I'm Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim discusses Europe's spending and defense challenge. The typical NATO defense spending calculus is changing fast. This impacts European economies in a way not considered just a few weeks ago. Markets are responding in kind. Jim, what is going on with Europe's defense spending?
I think it comes down to Trump, and it comes down to Trump has an America First policy. He gave a speech. He talked about this during Trump 1.0, but he's really pushing it hard now. He gave a speech January 23rd, his third day in office, to the World Economic Forum. And he said that the United States has been treated very unfairly, and that he is going to demand that NATO up their budgets, the NATO countries, there's 31 other NATO countries, to 5% of GDP. Well, they were running at a little bit less than 2% of GDP currently, and in Trump 1.0, they were running at less than 1% GDP. Now, by comparison, the US spends 5 to 10% of its budget on defense. So the immediate reaction out of Europe was, okay, fine. And they're openly talking about borrowing $3 trillion over the next decade for defense spending. The German parliament is discussing the idea of up $200 billion of defense spending and even suspending their debt cap. They have to balance their budget, and they're talking about they'll suspend it so that they could spend more on defense spending. And the day we're recording, the UK said that they're going to dramatically up their defense spending as well. And again, this is Trump said, you guys aren't paying enough. And they said, you know what, you're right, we're not. I think that this is really having, quite a big impact on markets. We'll talk about that in a minute, but I'll just tease it. If Europe spends more on defense, the US can spend less, not zero, but less. This is a reduction in the deficit. This is like an announcement that we're going to issue less bonds in the future. And that's why I think you're seeing such a big move out of our, we're seeing such a big move out of what we've been seeing out of Europe. Now, the last thing I'll mention on this, if we go to the first slide, is the urgency for why we need to do it. So Neil Ferguson is a economic historian, and he wrote an essay in the Wall Street Journal this past weekend, quoting Adam Ferguson. Adam Ferguson, not related, is a 17th century economist. And 300 years ago, Adam Ferguson said that any great power that spends more in interest than in defense will soon not be a great power. And what this chart shows you is in October of 2022, the US flipped over. We now spend more in interest on the debt than on defense. And in Neil Ferguson's op-ed in the Wall Street Journal this past weekend, he went through all of the examples of countries that wound up expending more on interest than defense, unless they reversed it quickly. The UK did after World War I. They stopped being a great power. So the argument is this is a security issue that the US needs to address its budget deficit from a security standpoint. And the first salvo is Europe, you got to pay more, like hundreds of billions of dollars more. They said, yes, we will. And the implication in the financial markets is, well, that means then the US's budget deficit could come down by way more than we're talking about what Doge is doing.
Can Europe pay?
That's a good question. And the answer is unsure. So if we go to the next chart, let's talk about where Europe is right now. Here is Bloomberg's survey of where the European economy is expected to be in green 2024's GDP growth, That's done. I left it on there for comparison. 0.7%, barely above zero. Red is 2025's estimate. Again, this is 70 economists or so. Bloomberg asked them to constantly update their 2025, 2024, and in blue is 2026 forecasts. In black is the US 2025. I put that on the chart for a comparator. The US is increasing and is expected to grow well over 2%. Europe's numbers are falling constantly, and they're expected to grow at somewhere around 1%, if not less. Europe is in a very weak financial position right now in the economy. And so that is going to be a real problem for them if they're going to say, look, we're very weak on the economy. We've got these deficit caps. Oh, we're going to just spend trillions of dollars on defense on top of everything else. They could do it, but it'll come at a cost.
And how does energy figure in, Jim?
So that is the key for Europe, is energy. So if we go to the next chart, this is gas flows from Russia to Europe, the big gas pipelines that feed natural gas into Europe. Just as a quick backdrop before I explain the chart, Europe, especially Germany, has benefited for years from cheap natural gas. That's why Germany is somewhat of a manufacturing power. You know, think Mercedes and Stuttgart and BMW and Bavaria, just to name two, and you got Volkswagen and Audi and a whole bunch of others. What does somebody need to be a manufacturing power? You need cheap energy. You also need cheap labor, but really you need cheap energy. And that's what they got from Europe. So the colors on this chart are all the different gas pipelines that feeds Europe from Russia. It fell off the map in 2022 with the start of the Ukraine war, and it downticked again in January when Russia said that they have to take another pipeline offline for maintenance. So Europe is getting, at best, maybe 15 or 20% of the gas that they used to get from Russia, and Russia's gas was very cheap. So if you go to the next chart, the other problem that Europe has is Europe has natural gas storage facilities, and they're very seasonal, and that's what the sine wave looks like. They fill them in the summer and they run them down in the winter because most natural gas is used for space heating and a lot of it is used for electrical generation. I'll talk about that in a second. But let's talk about their storage. As of February 22nd, they were at 41% storage capacity. All of the labels on the chart are where they were in February 22nd of every previous year back to 2009. And then I put the dotted line at 41%. This is below average. So they've run their gas storages down a lot faster than previous years. Why? It's been colder in Europe. It's not mismanagement or anything. It's just been colder. The last couple of years when they were at 63, 64% by the end of February, they had warm winters. They're not having a warm winter right now. So if you go to the next chart, the problem, of course, is now they got to fill this thing. And this shows you natural gas prices in Europe because of the loss of Russia and the running down of the inventories. The blue line shows you the spot price for natural gas. It's up 100%. It's doubled in the last year. The red line is what you would pay for natural gas for delivery in 6 months in the future, and green is for delivery 1 year in the future. These prices are up. They're going to have to pay a lot for natural gas. You've got a weak economy suffering basically from your manufacturing sector. What has got them weak is you've got them that their energy supplies are very depleted, and it's going to be horribly expensive for them to pick those up. So we go to the final chart in this mix. Europe also uses natural gas for electrical generation. So the blue line on this chart is how much it costs to produce electricity, a base load of electricity in Germany, and the orange line is France. And the difference between the two is in the bottom. France gets 70% of its electricity from nuclear. Germany in April of 2023 shut down their last nuclear power plant because of the green movement. And they immediately moved from having cheaper energy from than France because of the cheap Russian gas was cheaper than than nuclear, to paying a 26% premium. Again, the manufacturing hub has got a problem. They've got a real problem that they've got to pay up to get energy. You've got expensive energy, you've got uncompetitive manufacturing, and that's what they're suffering from right now. So can Europe pay? Sort of, they can pay, but they've got a lot of other issues with energy and with a weak economy.
What is the market response then?
So if we go to the next chart, this is all leading up to the market response. The DAX index, the stock, this is the DAX, the German stock index, and it is soaring, basically since the US election in November. And the orange, it's up 16%. And the orange line is the Euro Stock 600. It's up 8%, well ahead of the S&P and the FTSE 100, which is the UK in green, the S&P in red. So why are their stock markets soaring? It's simple, I think. It's stimulus. They have committed to borrowing $3 trillion. They have committed to ignoring their balanced budget caps. That's not only going to be for defense. They're going to spend it on infrastructure. They're going to spend it on a lot of other things. So it's, in economic terms, it's just pure old-fashioned pump priming. Borrow, spend, spend. And the European economies, especially the DAX, because the DAX, we talk about the Mag 7 being 33% of the S&P 500 and being very concentrated. 5 stocks in Germany are 60% of their stock market. SAP, their largest company, which is also a defense contractor, which is soaring on the idea that there's going to be a lot of defense spending, is 16% of their index, whereas Apple is the largest here in the United States, and it's 7%. So it's almost 2.5 times larger on a relative basis than Apple is in the United States. So their stock markets are soaring on this idea that there's just going to be pure old-fashioned pump priming spending, and they've got cheap stocks as well too. If we go to the next chart I think is probably the most telling of the charts. It is the difference between the 10-year yield in Germany and the 10-year yield in the US. Now the 10-year yield in the US is coming down. It's coming down, I believe, because Europe's going to spend a lot of money. We could spend a lot less. Look, we've got 60,000 US troops in Europe. Maybe we could cut that to 20 and let them take up the slack. And that means we could cut our European expense by 2/3, just an idea, and just to give you an idea. We're not going to go to zero. We're never going to go to zero, but we could come down quite a bit. And so our interest rates are falling because we've got less supply. Their interest rates are not, because they're going to have more supply. Borrow, spend could produce inflation. So while our rates are going down a lot in the last week to 10 days, all things being equal, that should have dragged down the DAX, the Bund yields, should have dragged down the gilt yields, the French haute yields. These are their government bonds. They're not going down. They're going sideways to up. So the green line on the bottom is showing you that the spread between US rates and German rates is collapsing right now. So if we go to the final chart shows you the dollar index. The dollar index has peaked, and it has come down too over the last couple of weeks, because as that spread, as we narrow the spread between US and European interest rates, in this case German, that weakens the dollar. And that puts the US, all things being equal, if we weaken the dollar, in a more competitive position, because it can compete better with a weaker dollar than it can with a stronger dollar. So where are we? Just even maybe 10 days ago, we weren't talking about any of this security arrangements at all. And by the way, this is part of this Mar-a-Lago agreement I've been talking a lot about as well. The third level of the Mar-a-Lago agreement is pay for security. Now, I want to be clear on one thing. A lot of people have misconstrued that as a debt swap of they're going to be forced to swap their treasuries for 100-year zero coupon bonds. That is just a possible way that they could pay for it. That's like arguing that I have to pay my mortgage and I'm going to write a paper check, and then people go crazy. You can't write a paper check, so therefore you can't pay your mortgage. You have to use Zelle. It's all the same. It's going to get paid one way or the other. We're just talking about the means of payment. The debt swap is a means of payment. If you don't like it, you think it's a bad idea, we'll find another means of payment. And for the interim right now, Europe is spending more money. That is going to prime their economy in a way we didn't think even 2 weeks ago. It's keeping their interest rates up. It's lowering our interest rates because we have to borrow less. It's weakening the dollar. So it's putting the US, all things being equal, into a better financial position. Now, I know we're a stock market centric world. What about the stock market? Its all-time high was less than a week ago on the day we're recording. It was 6 days earlier on the day we're recording. It is corrected a grand total of 4% right now, but we're acting like the stock market is crashing. It's not doing anything of the sort. So this whole idea about, America first, and that's what the Mar-a-Lago Accord was about, was to try and engineer a lower dollar. We seem to be having it because Europe has agreed to pay more in defense 3 weeks after Trump said you have to pay more. There wasn't a discussion. You're right, we're going to start paying more. We can issue less bonds. They have to issue more bonds. Their stock market's going up because they're going to get stimulated, but they have higher interest rates. There's a risk of inflation in Europe, a lot more than there was, say, 10 days ago. Our rates are coming down because of the perception that we can issue less. Now, that's all in isolation. You can be cynical and ask a very valid question. Are we really going to issue less? Are we really going to say, well, if Europe is going to relieve us of $200 or $300 billion of defense spending in the next couple of years, are we going to find other places to spend that money? Valid question, very valid question, and maybe we do. If we don't spend it there, well then, it's extra money that we could find to spend somewhere else. But that's what's driving the markets right now, and that's why European defense spending, if you're into financial markets in the US, into interest rates and into the stock market, is a matter for us to consider, because it is a form of us lowering our deficit right now. I know the last thought I will give you is, I know a lot of people are trying to ascribe what I would call traditional reasons for why interest rates are falling. Oh, it must be that inflation in the US is not as bad as we thought. No, there's been no data that suggests that. We thought it was a problem 2 weeks ago when it was at 460 yield. We've got no data to suggest anything other than that. And now we've just said, well, it must be that. No, it's not that. We still have the inflation issue. It must be that the economy is weakening. There's suspect data about whether the economy weakens. And keep in mind, data goes up, data goes down all the time. If you want to say the economy is weakening, give me 5 minutes. I'll find you 3 data points or 4 data points that say it's weakening. If you want me to find you 3 or 4 data points right now that says it's not weakening, I could do that too. And so we've decided that on traditional reasons, we've got to look for weakening economy. There must be a problem with the labor market. The inflation rate's coming down. The Fed's going to cut rates. I don't think any of that's going to be the case, which is why I understand why we're having this rally. I just don't think it's going to last, because I think when we all wash this out over the next month or two, we're going to find out our economy's not weakening. Our economy's not seeing inflation tick down, but their economy might be stimulating itself back into growth, back into more inflation, keep their rates up. Our rates will rebound. I don't think it's necessarily a bad thing if our rates rebound, but we're still stuck in this pre-COVID mentality that rates must go down. Otherwise, it's only good if rates go down and it's only bad if rates go up. That's not the case anymore. Sometimes in a stronger economy, in a more normal economy, interest rates can be a sign of health. And that's why I think they can be going up as a sign of health.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks again, and have a great day.